I was reading a note of yours earlier this week. The labour market rebalancing has been achieved. Can you walk us through just how we've done that?
Well, job openings have come down. Job openings, remember, are a measure of excess labor demand, with very little upward movement in the unemployment rate. Now, the unemployment rate has gone up, but it does look, for the time being, that the Fed was kind of able to successfully, trim excess labor demand without driving up unemployment all that much. And I think what's important now, John, is that, yes, the ECI, which you mentioned earlier, did pop in the first quarter, but the underlying, sort of drivers of that data are the average hourly earnings for non-supervisory workers. And we saw in April that that's cooling. Over the last 3 months, average hourly earnings growth for non-supervisory workers are barely up 3% at an annual rate. And given the growth in productivity that we've seen, even if you assume it's like half that, so let's say 1 to 1.5% productivity, you're talking about wage growth that is broadly consistent with the Fed's underlying inflation objectives, which is why unit labor costs, I think, have been cooling. So where's the inflation coming from? I mean, that to me is the big story here is, if you ask someone, why did inflation perk up in the first quarter, they can't really point to a fundamental reason for that. Is it because expectations are perking back up? No. Is it because the labor markets are reheating? No. Is it because the dollar's weakening, driving up, pushing up the prices for imported consumer goods? No, the dollar's generally been stronger all year. So you can point to things like, well, look, financial services inflation picked up and healthcare services and, motor vehicle insurance, sort of the idiosyncratic factors. I think it's important for people to kind of go to first principles here. And, this is why I think the case for weaker inflation is still quite strong.